In this example, we'll be doing practice exercise 13-2A that can be found in your textbook on page 607. We are going to be journalizing the entries for issuing stock. On May 10th, Century Realty Inc. issued for cash 90,000 shares of no par common stock that had a stated value of $30 at $42. On September 3rd, they issued at par 36,000 shares of preferred 1% stock for $25 par for cash. And on December 1st, Century Realty issued for cash 14,000 shares of preferred 1% stock that has a $25 par value at $33. So they want us to journalize the entries to record the May 10th, September 3rd, and December 1st entries. So, first entry is on May 10th. And on May 10th, the company is issuing 90,000 shares of no par common stock for $42 per share. Although it's no par, meaning that the state the company was incorporated in did not assign a par value, a stated value was assigned of $30. They tell us that we issue it for cash. A company will issue shares of stock to raise a lot of capital or assets for their business, typically cash. So that means we are receiving cash for our business. We are selling 90,000 shares of stock, and we are selling them at $42 per share. We always record the cash at the sales price. So in total, we are taking in $3,780,000 in cash. What we are giving to them in return is common stock. It's no par common stock, but we still list it as common stock. Common stock is an equity account, which means that it increases with a credit. All of our common stock and preferred stock accounts cannot be credited for more than their par or stated value. Again, we are selling 90,000 shares, and there's a par value of $30 per share. So we will credit our common stock account for $2,700,000. Since our debits and credits don't equal, we know we need another credit. When the price that we're selling our stock for, in this case is $42, exceeds the par or stated value, which in this case is $30, the difference goes to an account called paid in capital in excess of stated value in this case. So we simply take the difference between how much cash was received and the par or stated value in total to get our paid in capital in excess of stated value. We have our next entry on September 3rd. On September 3rd, we are issuing at par 36,000 shares of preferred 1% stock for $25 that has a $25 par. Remember that 1% value that's associated with our preferred stock is only ever used when deciding how we divide out our dividends. They're telling us that we're issuing it at par, which means the selling price and the par value are equal. Again, they tell us that we're issuing it for cash. We are issuing a total of 36,000 shares for $25 per share. So we will be receiving $900,000 in cash in exchange for preferred stock. Again, your preferred stock and your common stock accounts are both equity accounts and therefore both increase with credits, but can never be credited for more than their par value. Again, we have 36,000 shares. The par value is $25 per share. In this case, we do not have any paid-in capital in excess of par because our selling price did not exceed the par value. And finally, on December 1st, we are going to issue 14,000 shares of preferred stock for $33 per share. Again, we are issuing it for cash, so we debit our cash for the selling price, so 14,000 shares multiplied by the selling price, which is $33 per share. The company will receive $462,000 in exchange for preferred stock. We are selling 14,000 shares, and the par value of those preferred shares are $25 each. We can only credit our preferred stock account for $350,000, which means then that we have a paid in capital in excess of par on our preferred stock for the difference between the cash that was received and the total par value. Paid in capital accounts are also equity accounts, so they are credited to be increased.